Hello and welcome to another episode of Trust Issues. Today I'm sitting down with Richard Sennitt, manager of Schroder AsiaPacific, to talk about the opportunities for investors in the region. Richard, many thanks for joining us today.
Many thanks for inviting me on to the podcast.
So could you start off by providing an overview of the objective of the fund and your investment approach in terms of how you assess value and also what attributes you look for in a potential investment?
The company's principal investment objective is to achieve capital growth through the investment primarily in equities of companies located in the continent of Asia, excluding Japan, and it aims to achieve growth in excess of the MSCI All Countries Asia, excluding Japan index in sterling terms over the longer term. So in that sense, it's a trust that's trying to get a broad exposure to the Asian region. And the way that we do that is very much through a fundamental bottom-up approach. We believe that stock markets are inefficient, and the best way that we can extract those inefficiencies, if you like, is through a targeted stock selection approach. To help us do that, we have a team based out in the region of some 40 analysts, and they're based across 6 offices, and they're going out, and we do as a company, around 2,600 company meetings each year. It's very focused on that bottom-up side of things, and it's disciplined in its application. And the type of companies that we're looking to invest in tend to be companies which we describe as quality names. And what we mean by that, we like companies that either achieve a strong return on capital, or we believe they can do so in the future, and that they tend to be companies that allocate capital well and tend to have decent balance sheets to boot. And what we're trying to do is to look into the future and think about what can this company potentially make in the future, and is the market paying the right price for that? And if we think there's an opportunity taking that longer term view, that's the sort of company that we want to try and buy into.
Great, thanks for that. The trust has performed strongly in 2024. So could you talk us through some of the key factors behind this performance?
After a slow start, Asia's actually performed pretty well year to date, and I think there's been 3 drivers around that. Obviously, what's been happening to the path of global interest rates has been quite a factor, and as the expectation around rates come down, that's generally a reasonably positive backdrop for Asia. The other area where we've seen really quite strong returns has been in the IT sector. And that, I suppose, is with many countries worldwide, but particularly in the US, has been driven by what we're seeing on the artificial intelligence side and demand from that structural growth sector, which has benefited technology areas of the market. And then, of course, what's been happening to China. So obviously, people have been concerned about the outlook for the Chinese economy, and particularly around the property sector. But more recently, we've actually seen a bit more of a coordinated stimulus there, which has seen the market rally. And things which have really worked well for the trust, I would say, has been our overweight position to Taiwan, where we have had quite a bit of exposure to some of those AI beneficiaries, and they've worked well. And there's been a general pickup in demand as well across the IT names more broadly. The other area that has also worked well for us has actually been the exposure to some of the smaller markets and ASEAN, including stocks in the Philippines and Indonesia, and also positioning in Singapore, where we've been overweight.
Thank you. So staying on the topic of China for a moment, the trust underweight to China has been narrowing. Does the recent Chinese stimulus affect your view or your positioning there, and where do you see the opportunities?
As far as recent stimulus announcements, which we saw in mid-September, I think they were undoubtedly positive given their breadth and coordination. But the market has moved up pretty swiftly on the back of those and is trading more in the middle of its historic trading range rather than towards the bottom. So therefore, from here, I think we need to see more announcements on the stimulus side. Focus, in my view, more on improving consumption by starting to mobilise some of the savings which have been building up on households' balance sheets over the last couple of years. We've been consistently underweight in China over time, and I think that's partly for 2 reasons, partly cyclical, given the sharp slowdown that we've seen obviously in the property sector there, but also partly structural. And that's given the challenges that the economy faces longer term towards really rebalancing to a more consumption-led economy. And that really has been a big challenge in China. And that's because consumer confidence has been low. And that's partly because there's been a slowdown in the property market. And despite the fact that we've seen ongoing piecemeal stimulus, their focus has been on the supply side rather than the demand side, which I think has kept us away from some of the companies there. And what I mean by that is that there's been a lot of investment in what are growth sectors, such as wind, solar, EV. But because there's been that, if you like, overcapacity in those areas, actual profits which have come through to investors has been relatively muted. And that has kept us underweight. However, the market had sold off, and so we were starting to see more opportunities come through there. And so it's fair to say that we had been adding to names in China where we'd started to see a bit more value. But in aggregate, we still very much remain underweight.
And has the Trump victory changed your outlook for the region?
Well, I think the Trump victory obviously does have implications for the region. I think there's a couple of bigger impacts which it has, obviously. And first have been the more direct impacts that could come through from any tariff increases which have been muted. And you would have heard that there'd been talk of adding 10% tariffs to all imports into the US, but up to 60% on imports from China, which would obviously have a negative impact and would ultimately have an impact on the competitiveness in particular of Chinese exports into the US, whereas actually some of the rest of Asia could potentially benefit in the sense that they would become relatively more attractive from a competitive standpoint, given that they wouldn't have had such an increase in tariffs on them. What we did see last time around, I guess, with Trump 1.0 was that as tariffs came onto exports from China, we did see some price rises going on in markets to help try and recoup some of the impact of tariffs, together with some weakness across currencies, which also partly offset the impact of the rise in tariffs. But in total, it would be a headwind for exports from the region. The other impact, I think, that comes from Trump and his policies are more that they tend to be a bit more expansionary and reflationary, you could argue, because of his policies potentially around tax cuts and so on. And what that has meant is that expectations around interest rates have changed in the sense that higher for longer has become a new mantra, if you like, and that will undoubtedly have some impact on the region. In particular, some of the slightly weaker countries from an external balances perspective, and they tend to be some of the smaller markets, would be potentially impacted by those higher rates. On the flip side, it would be positive for the financial sector in general, banks in particular, and that's an area where we are overweight within the trust.
More generally, could you talk us through your current allocation in terms of sector and country weightings?
Yeah, I suppose, conclusion of all that on China was that we do remain underweight in China, but that is partly offset by our exposure to Hong Kong. And it's fair to say, as we were mentioning, that we have added to some of those positions there in recent months. But in aggregate, Hong Kong, we are still underweight combined Hong Kong, China. From a sector perspective, we continue to remain overweight financials, and that is quite a heterogeneous sector. And what I mean by that is it's well represented not just by banks, which we continue to like, but we also like some of the insurance companies. We also like some of the exchange companies, and there are good opportunities across Asia in those names. Elsewhere, we're overweight in IT. And continue to have exposure to the AI theme through our holdings in Taiwan, although we have trimmed some of our positions in Korean names. And I suppose worth mentioning that also from an Indian perspective, we do have some exposure to the IT services sector there, which if the economy in the US is a bit stronger, should benefit from that.
You mentioned India a moment ago. So we've seen a slight pullback of late as investors have rotated into China. Do you see this as an opportunity to narrow the trust underweight in India, or do you think valuations remain stretched there?
Yeah, we are underweight, and that I would say is principally driven by valuation. And so I think it's fair to say that at the moment, although the market has started to correct, valuations are still looking relatively rich vis-a-vis history in India and versus the rest of the region. But it's also fair to say that a lot of the more expensive areas of the market tend to be in the more small and mid-cap names. And I would say that the longer term picture for India still remains pretty positive. And I was there in September visiting companies, and you could sense the optimism. And so the longer term still looks good. But more recently, we have been seeing increases in equity issuance coming through. And it would be fair to say that earnings results that have been coming through have been a bit disappointing versus expectations. Given that, our focus in the market is still on the larger names within the market, including the financials and the IT services companies, but looking for opportunities if the market continues to pull back to potentially add to that market.
And could you talk us through the reasoning behind the trust's underweight to consumer discretionary and staples?
Yeah, we're underweight consumer discretionary, which is quite a diverse sector. It covers all manner of things, including things like auto companies, internet, e-commerce names, to name a couple. We're underweight within the sector in two key areas. One of those being the e-commerce names within China. There is partly around the fact that consumption remains relatively weak and competition is still pretty high. So happy to continue to remain underweight there. And in the other area would be India, where again it's more about valuations, particularly within some of the more domestic orientated auto names, which are pretty full, which means that we haven't got much in the way of exposure there. For staples, there has been a correction. Historically, valuations within staples have been pretty high, and that's kept us away because we felt companies were looking fully valued, but they have started to come down and correct and starting to look more interesting. So that has been an area where we've been at the margin starting to put money to work.
So changing topics slightly, where do you currently see the most attractive valuations?
Yeah, there's certainly a spread of valuations across the markets in Asia. And I would say when we're looking at the markets, valuations that look relatively attractive, within that would be some of the smaller ASEAN markets. We're talking about markets like Philippines, Indonesia, and so on. And across ASEAN more broadly, we actually have now around just under 20% of the portfolio in those markets. So definitely can find opportunities in that set of companies where there are still opportunities, I think, from the increasing middle class, also in some areas benefiting from more in the way of production being relocated into some of these smaller markets away from China as well, which is helping there. Hong Kong, despite the more recent rally that we had in September, also looks pretty reasonable from a valuation standpoint. And India at the opposite end is probably still the market which it looks less attractive.
So why do you think this sector lends itself well to active management, and how is SDP differentiated from its peer group?
This goes back to our belief that Asian markets are inefficient and the best way to extract value is through a fundamental bottom-up approach. And that belief, and what we've found through history of managing money in these markets for a long time, has been that active management can add value over the longer term. And that's why if you're going to get exposure, you do it through an active fund. However, I think to be able to do this successfully, you do need a stable, experienced team, which is consistently applying this approach over time. And I think that's one of SDP's strengths, given the team and the resources that we've got based out in the region. I mentioned the 40 analysts and so on, in what is, quite a diverse region by geography and industry. I think does require a large team to cover it properly. And I think that's what our team is able to bring. When you look at the investment trust sector, it's quite a heterogeneous sector. And I think SDP's size also benefits anyone wanting to get a broad exposure across the region.
Thank you. And one final question. What do you see as the primary growth drivers for Asian equities over the next few years?
I think Asia over the next few years has got a lot of opportunities to grow. So obviously it's thought of manufacturer to the world, and I think that still remains the case. But where I think it's made real progress over the last few years is moving up that value add spectrum. And so when you look at areas such as IT, it's got some real world-class leading companies, such as those that are producing goods to service the AI trend. You've also got domestic consumption continuing to grow over time, which will be another driver. And that, I think, will continue to be seen probably more clearly in some of Southeast Asian and Indian markets, where we'll continue to see opportunities coming through from increased financialization of the industries there, which I think for us as investors is going to continue to broaden the investment horizon and mean that active stock pickers have got a good choice of investments in which to get exposure to these themes.
And on that note, Richard, many thanks for joining us today.
Well, many thanks for having me.
I'd encourage you to visit the Schroders website to find out more information about the trust, and I can particularly recommend the manager's insight articles on investing themes in the region. You can also head over to the Kepler Trust Intelligence website, where you'll find more information on the trust, including our latest research note. Thanks for listening, and we hope you join us again soon for another edition of Trust Issues.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.